Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HARBIN Electric Company Limited annual report. HARBIN Electric Company Limited offers a diverse range of products and services to meet the growing demands of the power industry. The company provides equipment for various types of power plants, including thermal, hydropower, and nuclear power. Their product offerings include boilers, steam turbines, generators, and ancillary equipment such as control devices, valves, and pressure vessels. In addition to manufacturing and selling power plant equipment, HARBIN Electric also engages in research and development, production, and provision of clean energy products like solar energy, tidal power, and desalination systems. The company is involved in the turnkey construction of power station projects, servicing of thermal and hydropower equipment, and import/export of equipment for power stations. The company's services extend beyond manufacturing and sales to include after-sales service, research and development of engineering technology, and provision of environmental protection engineering services, such as desulfurization, denitrification, and dust removal. HARBIN Electric also offers a range of other business services including finance, wholesale of mechanical equipment and electronic products, leasing, export trade, water conservancy management, biomass power generation, and science and technology promotion and application services. HARBIN Electric Company Limited maintains a market capitalization of $53 billion, broadly in line with the industry peer group. HARBIN Electric Company Limited trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 2.89 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified by examining the key areas that have contributed to an increase or decrease in revenue. On the growth side, operating revenue has seen a significant increase of plus 15.6%, while investment income has skyrocketed by plus 765.4%. Principal business revenue has also experienced 19% growth, reaching $7,236,347,849.42. In addition, cash received from sales and services has increased by plus 13.2%, and other cash receipts related to operating activities have seen a notable rise of plus 30.3%. These positive trends suggest that the company's revenue is being driven by strong operational performance and investment income. On the decline side, interest income has decreased by minus 12.3%, while fee and commission income has plummeted by minus 75.8%. The net increase in repurchasing has also declined by minus 41.7% or $500 million. Other business revenue has seen a significant drop of minus 41%, reaching minus $163,725,520.26. Furthermore, the new type low-carbon and efficient industrial system segment has experienced a 41.45% decrease in operating revenue, while the clean and efficient industrial systems have seen a year-on-year decrease of minus 36.66%. The green and low-carbon drive equipment segment has also declined by -21.26%, and hydro power equipment has decreased by -8.1%. Gas power equipment has suffered the largest decline, with a year-on-year drop of -55.26%. The net income of the company experienced a significant increase, with two separate figures indicating growth. Firstly, it rose by RMB 665.81 million, and secondly, there was an even larger increase of RMB 722.39 million year-on-year. This substantial rise in net income can be attributed to various factors. A key contributor to this growth is the improvement in profit margins. The gross profit margin saw a notable increase of 1.74 percentage points year-on-year, reaching 14.27%. This significant jump was largely due to the substantial year-on-year increase in operating revenue and the improvement in gross profit margin. As a result, the company's overall financial performance has shown considerable improvement. The company's financial performance is a testament to its ability to generate significant operating cash flow. According to the provided summary, the net cash flows from operating activities amount to a substantial RMB 4,628,758,901.35, indicating a positive trend. Furthermore, it is confirmed that the company has successfully generated positive operating cash flow of RMB 4,628.76 million. This achievement underscores the company's financial stability and its capacity to manage its operations efficiently, ultimately contributing to its overall success. The company's debt level and interest expenses have undergone significant changes over the past period. Initially, it appears that the company has reduced its short-term borrowings and notes payable, indicating a decrease in immediate financial obligations. However, an increase in contract liabilities suggests a potential future commitment. A closer look at long-term borrowings reveals a decrease as well, which is consistent with the overall trend of reducing debt levels. Lease liabilities have also decreased, further contributing to the reduction in total debt. The estimated liabilities, on the other hand, have increased, but this may be due to accounting adjustments rather than an actual increase in financial obligations. In terms of interest expenses, there has been a notable increase of 134% compared to the previous year. However, it is also mentioned that the decrease in debt level and reduction in interest-bearing liabilities likely contributed to a subsequent decrease in interest expenses. The exact figure for fiscal year 2025's interest expenses is RMB 5,512,987.05, which is significantly lower than the previous year's RMB 12,063,335.28. Management is optimistic about the company's outlook, highlighting several key initiatives that will drive growth and development. The company plans to invest in critical projects such as nuclear power infrastructure capacity enhancement and digital workshop construction, which will not only boost productivity but also enhance competitiveness. The company's strategy for the future is multifaceted, with a focus on strengthening its business, accelerating transformation and development, and cultivating new industries. Management aims to improve innovation efficiency, promote comprehensive digital and intelligent transformation, and accelerate the upgrading of existing functions. The ultimate goal is to achieve a high-level start for the 15th five-year plan period, indicating confidence in the company's ability to adapt and thrive in an ever-changing market. There are concerns about inventory buildup in the company's current situation. The financial report highlights a significant increase in inventories, with a total value of 4,274,410,320.58. This substantial rise in inventory levels may indicate potential issues with supply chain management and storage capacity. If not properly managed, such an accumulation can lead to wasted resources, reduced efficiency, and increased costs for the company. That concludes the financial summary for HARBIN Electric Company Limited. Feel free to comment below, and I will be happy to answer them when possible.